Welcome back to RoxomTV. I'm your host, Shemi. So this is our special edition for Consensus Week here in Hong Kong. Throughout this week, we are bringing you exclusive interviews with builders and founders in crypto to understand the insider perspective, how they think, how they manage risk, and how they navigate the market through different cycles. So our first guest today is Terence Kwok, who is the CEO of Humanity Protocol. You might have seen the viral Tinder experiment where AI bots were able to convincingly chat with real people and even set up dates. A very powerful example of how fragile online identity has become. So Humanity Protocol is building a privacy-first proof of humanity system designed to help platforms tell real humans from AI without relying on invasive or centralized data collection. Terence is a long-term entrepreneur and builder, and today we'll talk about where AI and crypto are really heading, why digital identity and trust are becoming critical infrastructure, and what this all means in a world flooded with AI agents and deepfakes. So, Terence, welcome to the show.
Thank you for having me.
Yeah, so since this is your first time here on Roxom TV Hong Kong, why don't we start with a little background of yourself? So walk us through your journey. How did you how did you get from here? Like how did you build Humanity Protocol?
Yeah, so I was born in the U.S., grew up in Hong Kong, spent most of my life here. Started my first company after I dropped out of university. It was not in the crypto industry. In fact, back in 2012, if I got into Bitcoin, that'd be great. But it was actually in travel. So it was in travel hospitality. We were building technology, essentially software and hardware products for hotels. Because you go to every single hotel, even if you've been there many times, you have to wait in line, check in, passport, credit card. It's a very cumbersome process, and so we wanted to create smart technologies for hospitality. That business was actually doing quite well, so we grew it to become one of the first unicorns out of Hong Kong. Raised a couple $100 million. It was a business that was doing over $100 million in revenues until COVID hit, and it hit us really bad. So we ended up having to wind down the business as hotel occupancy rates dropped from 90% to 5% overnight. We had over 1,000 staff globally, and it was a very sad experience to have to wind that business down, even though I've been fully working on it from 2012 to 2020. And then I started looking at the blockchain industry, started looking at sort of blockchain as a technology and crypto as an industry, and thought this would be something super exciting. The idea that you can have no centralized parties in order to verify sort of any sort of transactions, right, is very, very interesting. So start looking at different sort of investments, looking at sort of things that I'm good at, which is sort of building products, building enterprise technology, that we think will solve problems for people. And a couple of years back, we were thinking about, okay, looking at identity as one of the key use cases that a lot of people have been talking about, probably back in the Ethereum ICO days, right? Payments, that was sort of Ripple, and then it was sort of like stable coins. But I think decentralized identity specifically, is something that people have been discussing, pitching. Nobody's really been able to execute. So we decided to give that a go, right?
Yeah, first of all, I find your journey very impressive. You managed to build a unicorn, so that was really something really impressive. So I wonder, since you went from more like a traditional background to right now in blockchain, whereas blockchain, there are different narratives. So like you mentioned, right now you're in digital identity. Is there a specific reason why you chose this narrative? Because like there are different sectors, maybe like gaming, or maybe some people are into NFTs, especially back in 2021. Like, what gave you the vision that, okay, this is probably the narrative, this is the direction that we should go for?
I think what is different from sort of my previous business versus sort of crypto in general is that crypto is very, as you said, narrative based. I think from our perspective, as somebody who focuses on sort of building products, we I don't necessarily think about the narrative as much. I think it's obviously useful when it comes to maybe it's fundraising or maybe it's looking at token performance, et cetera, et cetera. But ultimately, we're trying to solve a problem, right? And from our perspective, the problem of identity was already there. I think it's always been there in the sense that most of our information, most of our data is being held by a few very big tech conglomerates. But I think over the last couple of years, looking at what AI has done, looking at all the new technologies that are coming out in the digital space, we actually think identity and building something tied to identity, a product that solves some of these issues, could potentially become very valuable. So that's sort of how we think about it.
Yeah, and you mentioned that you grew up in the US, but you chose to build a business in Hong Kong. Is there like a specific edge you find Hong Kong as an interesting base to build a business, like any edge compared to the US?
Not so. I mean, I was born in the U.S., but I actually grew up in Hong Kong. So most of my time I've actually spent here. Um, I think in terms of traditional tech, ultimately it boils down to sort of the industry that you're looking at, where the talent is. I think in specifically with crypto, it's kind of interesting because Hong Kong has historically been pretty supportive of crypto. You look at, say, some of the other companies back in the 2010s that were built. Uh, Tether, for example, the company behind USDT, the original entity was actually set up in Hong Kong, right? So from our perspective, Hong Kong, it's always been very Web3 friendly, and so there's no reason for me to try and build this anywhere else.
Yeah, got it. Like I talked to a lot of crypto projects, and they're actually the originally come from Hong Kong. So that is the one thing I find very interesting as well. So let's talk about the Humanity Protocol, the project that you built and you've been building around for quite some time. So for newcomers, maybe for our viewers of RoxomTV, this is the first time hearing Humanity Protocol. Like, could you give me simple, like maybe in one simple sentence, what problem does Humanity Protocol is trying to solve, and why is proof of humanity so urgent right now in your perspective?
The company is called Humanity. I think the main problem that we are solving is an issue of trust. Historically, we sort of blindly trust the things that we see on the internet. And then, companies or people blindly trust information or data that people provide. Over the last couple years, I think trust has become a lot more difficult to come by, especially in the digital world, because of all the artificiality of artificial intelligence, right? When we look at social media, it's flooded with bots. It's flooded with accounts that are just pumping out content because it's plugged into, ChatGPT or Claude or Gemini. Um, when we look at sort of photos, images, videos, it's becoming harder and harder to differentiate what is actually real and what is not. Uh, becoming harder and harder to differentiate what is real and what is not. Um, so even when you think about a platform, a professional platform like LinkedIn, right? It is becoming harder to figure out, oh, is this profile an actual person? Is the information on there actually real, right? And there have been many cases of people getting sort of scammed or people lying about their information. So for us with Humanity, we are starting with what we call proof of humanity, which is verifying to begin with whether you are a person or not, and then moving on to go verify other pieces of information. right? It ranges from your nationality, maybe it's your age, maybe it's your bank account balance, maybe it's your where you went to school, where you work. Ultimately, we are trying to build sort of an infrastructure for people and companies to verify things. And we think that's only going to be more and more important.
Yes, I agree with you. Like proving someone's identity on the internet becomes more important than ever. And coming from someone who have been personally scammed by others on the internet, so I think like DID, digital, I mean decentralized identity is something very important. So you mentioned about like proving someone identity. So in that process, you must take a lot of data from someone, but yet you mentioned you care a lot about privacy and non-invasiveness. Could you walk us through like how does the tech work behind the
Yeah,
scenes?
so we have our own blockchain. So Humanity Protocol, it's been on testnet and then mainnet is recently live. And what we are essentially doing is we're creating something called verifiable credentials. And the idea is that we would have trusted entities to go verify things. And these get turned into encrypted credentials on the blockchain. And whoever needs to make use of these credentials will need to get the user's permission. And us as a company or as the blockchain or the public does not actually get to see this information. So one to start, for example, we do have like a biometrics based system. So we use palm prints, palm veins to sort of verify, okay, this is a real person. That is something that gets encrypted. And people, if a company says, I want to check if this is a person, then they can call our smart contracts or APIs in order to make use of these credentials. And then other pieces of information in a similar way, right? So we're working with financial institutions, for example. We recently did a deal with Mastercard, where people through the Mastercard platform can actually go verify what their assets are or what their credit score is amongst all the U.S. banks, right? And so Mastercard essentially is issuing credentials on Humanity. These are turned into zero knowledge proofs, and any third party company with the permission of the user can then try to get hold of this information, right? So ultimately, I think when we think about how data and identity has been stored historically in the digital world, it's largely by big centralized companies, right? Your Facebooks, your Googles have a lot of information about you. What we're trying to do is say, okay, we also want to have a lot of information about people on Humanity Protocol, but that data and information is not owned or controlled by us. It's owned and controlled by the user. And more importantly, especially in this world of AI, this information is verifiably true, right? So, how do I know it is true that you went to this university? Because, we're working with universities to have them actually issue graduation certificates or transcripts as verifiable credentials on Humanity, right? How do we make sure that, we can verify that you work for this company? Then, in a similar vein, we are working with different sort of companies, corporates, trusted entities to issue these credentials.
Does it mean that you're actively working with larger institutions or maybe even government in order to share that data? Like otherwise, how do you know this person, the health data or the
Yeah.
credentials?
So as I mentioned, like one of the first institutions that we announced a partnership with is Mastercard. We have a lot more coming, where it might be telecom operators, it might be airlines, it might be various things. Some of these credentials don't actually have to be that sensitive. It might even just be, for example, on Humanity on our app right now, you can go verify that you are, for example, a platinum member on Emirates. You can go verify that you are a gold member on KrisFlyer for Singapore Airlines, right? These are credentials where, it might serve some purpose for marketing, right? It might be the case that there are marketing companies or platforms that want to say, you know what, prove to me that you are a frequent traveler and I'll give you some discounts, right? So the way we look at it is, going back to sort of my background when I was starting my first company, which is, working with a lot of big hospitality groups. I think one of the key advantages my team, myself has is really working with on partnerships with different companies and trying to build products that really serve a purpose for them.
And one really viral experiment that you and your team has done is, of course, the Tinder AI experiment that shocks a lot of people. Like, were you surprised when you find out a lot of people actually fall for that so-called AI girl, AI models?
I'm not surprised actually, because right now I'm on Instagram and sometimes I see all sorts of content, whether it's people, whether it's, I don't know, like news events. The very first comment you would actually see is this AI, right? So yeah, when my team told me, hey, let's do something like this, I said, sure, go ahead. And so what we actually ended up doing was they set up a bunch of accounts on Tinder in Lisbon, in Portugal, essentially. And we plugged these accounts with obviously, deepfake generated images, with, some made up profile, and then also plugged it into to ChatGPT so that all the flirting was done by a bot, essentially. And what we ended up doing was having these bots set up dates with, I think it was like 20 guys and 20 girls, men and women, and organized for a first date at the same location, a nice restaurant in Lisbon. Everybody showed up, and just to realize that, oh, they were actually flirting with an AI agent for the last couple of weeks. Um, it was a very fun experiment. I wasn't there actually, but I have seen a lot of the videos. Spoken to my team. Everybody was very shocked, but then very keen to actually build some real human connections, and stayed behind. Everybody had dinner, people chatted, and my understanding was there were people that ended up sort of going on second and third and dates afterwards as a result of that experience and being able to meet real human beings.
Wow, that is a very interesting. Thanks for sharing that experiment. So, like, because when we think of humanity protocol, like the first marketing, almost like a marketing campaign that I personally thought of is of course, the Tinder one. So, I wonder, like, after doing this social experiment, was that like a huge uptake when it comes to the user, when it comes to adoption for humanity protocol?
I mean, we're growing, and our user base is definitely growing. And then in terms of partnerships, in terms of enterprises, we're starting to bring on more institutions in terms of credential issuance. And then we're also going to be rolling out our APIs and SDKs for developers, for companies to use very soon, so that they can actually check against information. Right. So there might be a chance that hopefully very soon, dating apps, social media apps, your professional social networks, um, whatever it is, right? We'll actually start be able to use humanity in order to be able to check for certain pieces of information, right? It might even just be, hey, before going to a gambling site, I want to check that this person is above the age of 18. Um, Without necessarily revealing any other piece of information. Or, as I mentioned earlier, a marketing platform that wants to know if you're a frequent traveler, or anything in general, right? Am I talking to a bot? Because you're at least verified to have these credentials. So it's definitely super exciting for us, and every day we see crazier and crazier technology coming out on the AI front, and it makes us pretty confident this is super necessary.
Yeah, I mean, one thing I find it interesting about Humanity Protocol is that there's a little bit like a DID, of course, is in crypto and also AI. Like there are different stuff going on inside a project, and that's why I have conviction in DID, because as you mentioned, this is a more like a long-term infrastructure play, not so much as just like flipping narratives, because like in crypto, narratives changes overnight. So I wonder, like as a builder, and you've been building for years for different projects, not just in crypto. Like right now, arguably we are in a bear market. Would you agree or disagree?
I mean, I think the markets are volatile, right? I think when you look at sort of crypto, the markets are constantly going up and down, and has a lot tied to sort of, I think, the macroeconomic situation. Sort of, you have a lot of uncertainty. The economy is not great in many countries, but ultimately, I do think crypto is here to stay. And I think for us, we also try to think less about that, and focus more on, what is the long-term trend. And we look at the long-term trend in, 5 years, 10 years, 15 years, 20 years. It's, from my perspective, the digital world is going to be very much AI agents driven. I look at the physical world, there's going to be robotics. And what we're trying to do is make sure that we have infrastructure and technology that we're building that solves some of the issues that people have, or people might run into as this world becomes more real. So, is it a bear market? I mean, judging by the price of Bitcoin, it's actually not too bad from my perspective. It's, you look at a year ago, I think it was sort of similar price. There are other asset classes that have substantially dropped. You can't compare it to like gold and silver, which has, grown a lot. But ultimately, uh, I think, whether it's what we're trying to do or crypto, it's here to stay. So, whenever there's sort of volatility, people kind of panic. I think, I'm just always hopeful.
Yeah, I mean, I'm with you. So, I personally, I think the world is only going to get more digitalized. So, having use case like real world use case like DID actually is helping a lot of people. So, I wonder for your own stance, there are for DID, there are million of use cases. Maybe I don't know, apply to healthcare, apply to jobs. Like out of all these real world use cases, which one excites you the most?
I really think the online cases are super interesting. Even just, I think the imminent issue is, figuring out whether you are, looking at content that's created by a person or looking at content that's created by a bot, right? Twitter recently came out with some bans on like different companies and APIs because they're like, we just don't want all this AI sloth, right? So, I think that's one very simple and key use case. And then the other thing, it's really funny. I was talking to one of my colleagues yesterday, right? He essentially built a little bot with Open Claude, or like Claude bot, where it automatically uses WhatsApp and texts his mom from time to time because he's too busy. Um, and I think only going to get scarier and scarier, right? And at some point, I think as humans, uh, you kind of want to know if the person you're talking to is a person or not, right? I'd rather, if my mom is texting me, I want to know that it's out of the agency of my mom rather than her digital twin, of an AI. So I think all of these things are allowing us to move into uncharted territory, and it's the ability to differentiate and the ability to trust, I think, will become more and more important.
Yeah, I love the example of OpenClaw. I mean, I haven't really tested out yet, but I've heard really amazing things about that AI platform. So, what is currently like what is the biggest challenge that you think humanity protocol will need to overcome at this stage?
I think I mean, there are always challenges, right? But I think for us, it's heads down building. So we're just building the product, building the platform, and then starting to work with companies, educating them that this is important. I think a lot of times, like people don't really see they see the good side of let's say AI, because, it's cool. It looks, it's in fact pretty magical, some of the things you can do, right? But then not necessarily realizing that there are potential risks. I think sometimes it takes time for people to realize that. So I think it's there's an education process. But beyond that, I think for us, things are going well. We're launching a bunch of stuff, onboarding many ecosystem projects, companies, onto humanity. So I think it's we're in a very good place.
Awesome. So if our viewers want to know more about the updates of Humanity Protocol, or maybe just want to test it out themselves, where's the best way to reach out to you guys?
Our website is just humanity.org. My Twitter, you can DM me, is just Terence _ Kwok. And then our company Twitter is Humanity PROT, Humanity Prot. So yeah, feel free to reach out, and we'll be launching a lot of interesting stuff in the coming weeks and months.
All right, amazing. That's all the time we have got for this segment. Huge thank you for Terence Kwok for joining us and sharing his insights on AI, digital identity, and where the space is heading next. So we will take a short break for now, and when we come back, we're diving straight into Ethereum. ETH has been struggling on the price side, which raises a big question like how are ETH treasury companies surviving and managing through this market or bear market? One of the biggest names in the space right now is Sharplink Gaming. So joining us next will be Matt Sheffield, the CIO of Sharplink, to break down the ETH treasury strategy, so conviction and how they are navigating the current marketing environment. So stay with us. We'll be right back.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick, monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Fuck. Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
Welcome back to RoxomTV, and thanks for sticking around with us after the break. So joining us right now is Matt Sheffield, the CIO of Sharplink Gaming. Ethereum right now has been under a lot of pressure on the price side, and that's raised a lot of questions around ETH treasury companies, how they manage risk, maintain conviction, and survive through tough market conditions like the current one right now. Sharplink is one of the largest ETH treasury players, making this a perfect time to understand the strategy from the inside. So today we'll dig into how Sharplink thinks about ETH as a treasury asset, how they manage through volatility, and what they believe comes next for Ethereum. So Matt, it's great to have you on the show.
Thanks for having me.
Yeah, since this is your first time here on RoxomTV Hong Kong, why don't we start with a little background of yourself? Like, walk us through your journey. How did you come across the role at Sharplink Gaming?
Yeah, absolutely. So I started off in traditional finance at Bridgewater Associates, where I traded rates and credit for a long time. And that's where I got a lot of experience in market microstructure and liquidity. Found it fascinating. But I was also trading crypto in my personal account on the side. And there was actually a decent community of us at Bridgewater that traded crypto. We didn't, I'd say, talk about it in terribly open, at least the first couple of years. It wasn't yet, I think, an established enough asset that people were necessarily talking about it on the floor. But then I'd say in like 2020, 2021, especially as things got more interesting, more of us started to have open conversations about it. It became a more interesting asset class to discuss like at the institutional level. And a few of my colleagues and I ended up going and starting a crypto hedge fund in 2022 with the goal of kind of being like an institutional grade product to help the pensions and endowments of the world who had previously not really been allocating to the crypto discretionary space have like a product for their first foray. And I did that for a while. It was in the post FTX period for most of the time. And I think that institutions probably weren't as ready to underwrite that type of risk as I expected. And I joined a firm called FalconX in 23, one of the largest market makers in the space. And we got extremely active in the last year in these digital asset treasury companies. We invested in about probably 25 of them, principally. And I ultimately connected with the team at Sharplink last year and was unbelievably impressed by what they were doing, the mission, and ultimately joined them later last year to help them build out this productive treasury.
Yeah, I mean, that is a very impressive journey. So jumping from hedge fund to market making, and right now in one of the largest ETH treasury companies out there. So like let's address the elephant in the room, because right now Ethereum is down quite a lot. So does it basically from an institution perspective, like do you guys do have conviction that okay, ETH gonna bounce back from here? Like is there any strategy, especially in a bear market right now?
Absolutely. So one, we have a very strong thesis behind Ethereum being like a generational opportunity and that we're at a bit of a turning point in a very positive way for institutional adoption. But the other is that we wanted to build a company that was robust, not just to capitalize for our shareholders on bull markets, but also to be able to generate outsized yield for our shareholders in bear market. And so our goal with Sharplink was to basically build like an Ethereum denominated wealth accumulation vehicle. The best way to express if you want to be long ETH already. And so with that in mind, a lot of what we do is to try to generate Ethereum denominated yield for our shareholders so that every day you're holding us, ideally, the amount of your ETH per share is going up. And that's kind of our North Star that we can talk about a bit more, but it's designed to be both a bull market and bear market vehicle to express that Ethereum bullish view. We personally have an extremely strong view that we're at a unique tipping point. Like the banks are explicitly saying out loud, we are going to be going full force into the real world asset space. We see the stablecoin growth, we see the volume growth. All these institutions that for years, anytime they would even whisper the word crypto, we would blast it out on every one of our media outlets. Now they're telling us it's coming in 3 months, it's coming in 6 months. Some of them have already started to do it. Some of them have said it's one of our top priorities for 2026. Some of them said it's our top priority for Q1, Q2. Like it's happening at such a breakneck speed that I think we've desensitized ourselves to some of the headlines, but we're actually seeing an incredible amount of adoption, and we couldn't be more bullish ETH in the short medium horizon.
Yeah, one thing about ETH Treasury company is that what you guys do is raise money and use that money to purchase ETH. So when it comes to the execution, do you like equity raises and ATM programs, like are you worried about dilution at all, or you just think okay, per share there will be more Ethereum per share?
So we are worried about dilution, but it's specifically it's ETH per share dilution. So if you raise equity when you're trading above the book value, intrinsic value, in Ethereum terms, you can increase the Ethereum per share if you buy more Ethereum with those dollars. And MicroStrategy kind of pioneered putting digital assets on a corporate balance sheet and this concept of like multiple of net asset value, MNAV, when it's trading above one, using something called the ATM, like you alluded to, issue common equity when it's trading at a premium. That is how we raised a lot of our capital to date, because it was accretive on an ETH per share basis. We have explicitly said we do not issue equity when we're trading below an MNAV of one, because we only do accretive to ETH per share deals. So dilution is very important, and we just make sure that we're always optimizing for that North Star of ETH.
So right now, not only ETH treasury companies, but like Bitcoin treasury companies, a lot of them are underwater. Like you mentioned, a lot of these companies, they can't raise new shares when the mNAV is below 1. So are you personally concerned about this trend, like this narrative? Is it going away, or just basically the winners will take all?
So I definitely think that there's two dynamics there. One is I do think, to answer the second one first, actually, that there's an economies of scale to running this, not only from an operational leverage side, like you want to have more assets to spread your roughly fixed costs over. That is net better. But there's also a liquidity element. You can only raise so much from the public equity markets relative to how much is trading on a daily basis or potentially your existing market cap. So if you're a small company, or if only $2 million a day is trading of your stock, if the market does decide to start trading above 1 mNAV again, you can't actually raise very much equity. We've raised almost $3 billion in equity. That was because we're a fairly liquid, high volume stock on NASDAQ. And that's really important as well to getting more institutions on board. They need to know that they have liquidity to be able to get in and to be get out of something. And then on the first one, I'd say like the narrative is very different, I think, depending on what your asset is in the treasury. So Bitcoin is a store of value, digital gold, and that is a fantastic corporate balance sheet asset from a proof of concept perspective, because the world got to see what MicroStrategy could do, taking Bitcoin, putting it on there, but they had to generate financial yield because there is no native productivity to Bitcoin. And that's the big difference. So they've done an incredible job of kind of pioneering this whole capital stack of preferreds, converts, etc. And they've given effectively an instrument to anyone that's interested along the risk reward stack. But you have to financialize yourself at that point. The common equity becomes a bit more levered. It's not necessarily like a clean linear play. It's a very interesting play, but it's got more leverage, or gearing, as I believe what they call it on their website. Whereas Ethereum, because it has that native yield, you have a naturally productive asset that's earning us revenues every day that we're staking. We're able to go out there, take advantage of the composability, and actually generate heightened on-chain yields, which we can talk about. And so it's inherently just a different kind of company. I think digital asset treasuries kind of became this broad term that the industry started to use mostly in the last year, honestly. But it paints a pretty wide kind of like stroke around 200 or so companies that raised money to buy crypto in the last year. In reality, a lot of us are doing different things from one another, and it's more like a menu of options, just like you have in any other sector, as opposed to one single strategy that relies on mNAV trading at a premium. Like yesterday, we had less ETH than we have today. Tomorrow, we will have more ETH than we had today as a result of us earning these yields. That is a fundamentally different strategy than trying to go and issue purely financial products to generate that synthetic yield.
Yeah, so based on what you just told me, so for the biggest difference between ETH treasury company and Bitcoin treasury company is that ETH comes with that staking nature. So you're going to earn a yield. So right now it's around 3%, 3-ish%. So my next question is that having that 3% yield for Sharplink gaming, like right now, Ethereum is down significantly. Is that enough to keep it profitable and keep the business running?
Yeah, so we've already actually published 2 quarters of financials, and our annuals are coming up soon. But we have about 866,000 ETH on our balance sheet. So as of the most recent post that we put out, I believe on Tuesday, that was generating around $1 million US a week of revenue just from staking. That's assuming the staking yield you mentioned, and that all we're doing is staking, which we immediately staked about 98% of our holdings, effectively day one, because we wanted to get kinetic, start generating the yield, have the revenue there to increase our ETH per share, regardless of whether or not we're in the capital markets. But we've now gone out and start doing additional deals and additional deployments with the target of generating yield in excess of the Ethereum staking rate, so that we can even heighten that figure further while doing it in institutionally rigorous ways. Since at the end of the day, we are trying to be a long-term ETH accumulation vehicle, not a high volatility kind of fund. And so when we put our ETH to work, we can generate higher yields and once again increase either revenue or capital appreciation depending on kind of what types of deployments we're doing.
Yeah, I kind of want to get your own take onto the whole Bitcoin Treasury and Ethereum Treasury, the difference between them. Since Ethereum Treasury companies, there are like a dozen more or less of companies are doing this, whereas Bitcoin, there are more than 100 companies trying to copy MicroStrategy. So my question is, like, since you are so bullish on Ethereum, like there is the native staking, the nature when it comes to ETH, like, do you think maybe ETH Treasury is a more long-term play, like around like this dozen companies in ETH Treasury has a higher potential of surviving this bear market compared to Bitcoin Treasury companies?
I personally do, because of the productivity and the yield you mentioned. Like, it creates a more sustainable vehicle. That's not to say that I don't think Bitcoin treasuries have a very prominent place in the market. If anything, I think that they can potentially provide a more differentiated strategy approach because they're not going to be going for native productivity. So I think you'll see people in the Bitcoin treasury space doing everything from running Bitcoin related operating businesses to maybe the real world asset space and trying to maybe play on the L2s or wrapping their Bitcoin and staying a little bit out of the Bitcoin universe and actually moving it into EVM world, but having Bitcoin as their kind of core asset. Whereas with Ethereum, I think not every Ethereum treasury is even staking, but a lot of them are pursuing similar strategies to what the Bitcoin treasuries were already doing, just simply with a different asset. Like Sharplink has always been different, trying to maximize for the native productivity as opposed to maximize the financialization, because that just wasn't what we thought was Ethereum's most attractive attribute. So I think we're very much in the early innings of digital asset treasuries. I'm sure some of them are going to evolve their strategy as they see what the market likes and doesn't like, what's working and not. But I was actually expecting to see more productivity coming from like the Ethereum treasuries or any protocol, honestly, that has a native staking yield. I think we're still in the earliest innings for seeing what treasuries evolve into, though.
Yeah, especially like if we compare the price action. So if we take a look at ETH versus BTC, like ETH has been underperforming BTC for quite a while, and arguably, like, okay, ETH broke its previous all-time high, but it barely broke its previous all-time high. So if you compare that to BTC, it looks like a very weak chart after all. So is this like the argument, like going back to you, we're just being too early for ETH, like ETH gonna have its moment in maybe sometime this year or next year?
Yeah, exactly. So I think that it's always been an adoption story for both assets and for crypto at large. And so Bitcoin was, for many people, the easiest to understand and be able to put into their portfolio first. A lot of large institutions were able to underwrite the digital gold element of it. Obviously, with the release of a lot of the ETFs in 2024, it made holding Bitcoin even easier. And so we saw further adoption. And it also had a bit of a geographic play. Like there were a lot of countries who benefited from the digital gold truly for their monetary reasons, not simply because it's a risk asset. For a lot of other people, I think Bitcoin still fit in as a risk asset, though. They were putting it in the part of their portfolio where they speculate, or they at least take like kind of like the longer tail risk, like the high volatility stuff, where you would put your tech stocks and things like that. Ethereum has always followed Bitcoin, at least historically, from like a liquidity perspective. Bitcoin tended to lead, in part because people traded crypto like one industry. Like if crypto as a whole was not in favor currently, there really was no asset you could be in that was protected from an overall sell-off, because it wasn't actually fully being traded like digital gold. It was still getting traded like a risk-on asset for the large portion of people who were adopting it for the first time. Ethereum is the same way, except even earlier in its adoption cycle, because the institutions have just started coming in mass on chain, and they still haven't even really potentiated. A lot of it is now explicit timelines that we have, like, okay, great, we're coming on chain in the next quarter. We're going to tokenize this fund complex this year. Anywhere from 90 days to 360 days, a most recent headline for when we're going to potentially start to see like a new real world assets issuance from a certain large issuer, and another one's launching a stablecoin. These things have all been now announced with concrete timelines and sizes, but they still haven't happened yet, right? And so that's what makes it so different. Is I think anytime someone makes their first investment into Ethereum, that's like a seismic stepwise move. And especially the institutions we're talking about, it's not a retail story anymore where it's like, okay, great. How do we get the next million people, 10 million, 100 million people onboarded? It's how do I get an institution that has the ability to buy 20% if they wanted to, and it would be a drop in the bucket for their portfolio of the ecosystem. And those are stepwise moves. They happen slower, so the time between every news announcement, I think, feels more tedious, but in reality, it's actually happening quicker than I think any of us foresaw.
Yeah, I'm definitely sensing a lot of bullishness coming from you. So, one edge that Ethereum has over Bitcoin is definitely RWA. Like, it's a lot easier to build things on the whole Ethereum network. So, I wonder if Sharplink is doing anything when it comes to the long-term play in tokenized assets or in finance.
So we've started to get involved with announcing that we're going to tokenize our own equity with one of our partners, Superstate. And that was really important to us because we do believe that the RWA ecosystem is going to be the largest entry point for a lot of traditional finance, as well as honestly a lot of users who aren't necessarily interested in trading crypto, but they're interested in the benefits that decentralized trustware and blockchains bring to you. People who eventually may not even realize that they're interacting with Ethereum. They're simply using an application that is leveraging it on the back end. That's really important to us. So we want to be an active participant in the space. We also want to make sure that we do it in like a very institutional grade way though. So, the change happens quickly when you look back on it, but I think day to day, the headlines make it seem like it may be going slower. At the end of the day, we're still a fraction of the overall global market that is available for financial assets. Like when you visualize on a chart, talking 30, 35 billion of what is 700 trillion of global financial assets, you can barely even see the spec. And so when that doubles, it still doesn't grow the size of the spec on the chart, but it actually does have a material impact on the network at large. That's kind of what we're seeing right now. And especially, honestly, being here in Hong Kong and having so many great conversations with family offices and with large institutions, they really do care about the RWA narrative. They want to partner with people who understand how to do it in a very professional, institutional way because the risk is their biggest concern when they first underwrite crypto. But no one is going to jump in unless they do it in the most prudent way possible. And so I think those conversations have been happening for the last year, 2 years quietly. And now we're seeing them all kind of come to a head and leading to this kind of now race for people to get things deployed before one another.
Yes, I do notice, like when I talk to institutions, almost the first narrative or the first thing in mind for them to get into crypto is RWA, and that definitely would unlock like billions of dollars. So that's why a lot of them, at least the projects that I talk to, find it very intriguing. But let's talk about risk about of Ethereum, because like especially these past few days or past few weeks, there seems to be a lot of negativity around layer two. So, do you personally think like layer two is just like it's going away? It's no longer helping Ethereum like the original idea was?
I think layer twos play a pretty crucial role in the ecosystem right now, which is that Ethereum did the hardest part first and continues to, like building cryptographically secure things and trying to innovate without compromising on security. I mean, 10 plus years of uptime doesn't exist definitionally on any other chain, but it's also extremely impressive, even if you look at it compared to any enterprise applications. No one has that kind of track record. But the thing is, for you to be able to do everything the best requires you to potentially compromise on that in the short term. And so that's why I think having the security layer element of it and then having layer twos that prioritize being the best at something. Maybe it's the best at throughput, right? Like that is a way of being complementary, especially in the short term where you say, okay, great, people are not going to compromise on their security needs. So they need it to eventually be on Ethereum, but the layer two might be able to give you the throughput you need to be able to, let's say, trade on chain. You don't want to have the latency there. Otherwise, you're going to another layer one, but that means you're compromising on the security side. And so the large institutions often aren't willing to do that, rightfully so, because the big difference, especially for RWAs, is that yes, how quickly you can trade something on chain is certainly important if that's what you're looking to do. But the RWAs are going there to be securitized. They're not necessarily going there specifically to be the venue of trading. And so what you're going to optimize for is, where do I know that this, if I were to walk away tomorrow, is still going to be there in 10 years without being hacked? And the only chain that has that security record is Ethereum. That being said, if you want to go and actually swap yourself, you might prefer a layer two that has faster TPS. So like, I think it's quite complementary relationship. I understand there's, obviously a lot of conversations happening about this right now, but I see it as like a win-win. Like, you have people who do something great leveraging the security layer.
Yeah, so layer two is helping up a little bit of traffic, not so congested on Ethereum. So we have addressed risk number one. Let's move on to risk number two. So the second risk that I want to talk about is Vitalik Buterin himself, because like he has been dumping Ethereum, dumping ETH recently, or he has been doing that for quite a while consistently as well. So how do you interpret that? Like even the original founder of Ethereum, like losing conviction for ETH, like how does it change your outlook at all?
I don't view it as Vitalik or the Ethereum Foundation losing conviction. People have expenses to run businesses, to run their lives, etc. You ultimately need to be able to pay for those. The numbers that I'm seeing are very, very small in the grand scheme of things. I mean, if you look at what a daily trading volume is in like one of the ETH ETFs, then the value of these sales that we are talking about is 1, 2, 3% of those daily trading volumes, like extremely small. And I think you ultimately want someone to, yes, you want someone all in. You don't want them so all in and leveraged to the point where they can't make the clear-minded decision. So like, I think someone in general, not just speaking about Ethereum, it's great to have extremely strong alignment, but you don't want that alignment to go so far that I think it puts you under pressure to do shorter term things, which we've never seen from them, quite frankly. They've always made, in my opinion, like the decisions looking at the 5, 10, 15-year mission. But I never viewed these sales as lack of conviction. I just view it as a business that needs to go and run itself, because at the end of the day, unfortunately, most people still have to get paid in fiat because their obligations are in fiat. Until that date completely changes, foundations are going to have to sell some of their tokens to cover costs.
Yeah, I mean, I love that. That is something I educating my viewers every single day. Like when you profit, it's okay. Like if you have any obligation, any things you want to enjoy in life, maybe even support your kids, like it makes sense to take a little bit profit off the table. So moving on to as maybe as a retail investors, like if you're trying to give them advice when it comes to whether to invest into ETH Treasury stocks versus holding ETH directly, like which one you recommend based on their own financial situation?
It's a great question. I think it's a very personal decision based off of like the way that you're going to treat your portfolio. Like, ETH treasuries, generally speaking, are going to be more volatile than Ethereum, because you're not just taking the underlying asset, you're also taking what management is doing on top of that and adding it. So I believe in the case of Sharplink, Ethereum contributes about 2/3 of our volatility, and then there's another 1/3 remaining from the overall market pricing their forward-looking expectations of the industry, of us, and then honestly a lot of it's short-term flows based. As a retail investor, if you have the time, experience, know-how to go and buy Ethereum, put it into a wallet that you feel secure with, go and deploy on chain in like ways that you think are strong risk reward decisions and monitor those positions, etc. Like, I think that's the best thing to do. But that is a full-time job for a very large team, in my opinion, to be able to do it at the level of institutional rigor where we're comfortable underwriting DeFi protocol risk. I think at the end of the day, there's an economies of scale that we're able to achieve. We're able to negotiate large deals with really large blue chip DeFi players where we're getting paid in excess of the yield that you would be able to earn if you went directly to a protocol in many cases, because we're bringing a large deal at once. So that kind of ability to bargain on everyone's behalf is one of the benefits of being involved with a treasury that has those scale. That being said, if you are a highly capable on-chain trader and you know all of the security needs that are best practices, like, it's fantastic to have more people like that in the industry. So I really think it just depends on your personal time allocation and your comfort. And then the last thing I'll just say is never put yourself in a position where you're watching the price of your holdings 24/7 and feeling the need like you need to sell on a moment's notice. That probably means that you are too levered, whether or not it's literally taking leverage or just too much of your portfolio is in one thing. Too much of anything is not going to be good, and you're going to end up making decisions that aren't actually optimized for the long run. If you can weather the volatility, stomach it, and know that we're on a long-term path of growth, but that the short term is going to inherently be choppy, it's a virtue of the crypto ecosystem that it's so volatile. That means there's a lot of upside as well, but the downside comes with it. So just never leave yourself in a position where you've got so much invested in one thing that you feel nervous, and that'll lead to kind of worse decision making.
Yes, I especially love the last part. Like if you are losing sleep and watching the Ethereum chart every single day, then maybe you're overexposed. Maybe it's a good idea to look at other assets, or maybe even take some profit if you are in profit. So for Sharplink, what is the next step for Sharplink? Maybe for the rest of 2026 or 2027, what are the milestones you guys trying to achieve?
So this is the year where we make our treasury extremely productive. So basically everything that we're doing already, and then what we're planning to do in the future, we're going to try to add one new level of sophistication to each deployment to not only increase the yield on the portfolio, but also to educate the market, our investors, as to what we're doing, why we're doing it, how we're thinking about it, how we're de-risking it. So an example of our first on-chain deployment was we did a $200 million deal with our friends at EtherFi, EigenCloud, and Linea. And we said, okay, we're going to deploy this for multiple years. This brings really sticky TVL to the ecosystem, long-term alignment of incentives, and each of our partners are giving us OTC yield incentives in ETH for doing so, which obviously benefits Sharplink shareholders for doing it first. But what we were able to do at that scale was go work with our partners at Anchorage and say, would you be willing to build this functionality without leaving your qualified custodian? And that was huge. That was a first. No one's ever done any of these types of deployments before out of a qualified custodian. You previously had to choose between taking an MPC wallet or living within the qualified custodian. We didn't have to make that compromise anymore because we were able to do it at large enough scale that it made sense for everyone to prioritize. I want to do the next version of that, and then the next, and the next, because every time we do that, not only are we probably generating additional yield in excess of the Ethereum staking rate for our shareholders, we're also making Ethereum's DeFi more productive by allowing other institutions to do the exact same trade we just did. So whereas a month and a half ago, you couldn't have called up Anchorage or any other qualified custodian and said, I want to go do this deployment from my wallet. Now that we've done it, all their other clients can, which is fantastic because it means more institutional assets can flow into low risk DeFi, do so in great ways, take advantage of on-chain yield, become active market participants. Buy and hold was great. Like, it was amazing to get the ETFs into the space. It brought a new wave of institutional capital and people interested in then understanding it. But the next step is to actually get people natively integrated. And the way to do that is to show the world what is possible with Ethereum on a corporate balance sheet. So I think we're going to do a lot of very interesting deployments this year.
Yeah, so final question before we end this segment. Is there any advice you could give to institutions or maybe professional building around Ethereum today? Because like right now, it could be quite tough. Speaking like coming from you especially carries a lot of weight because you have been in crypto for a very long time. You have built helped build different projects as well. So is there any final advice you could offer to institutions or professionals out there?
Well, one thing I would say is that the crypto community is way more willing to spend the time to educate newcomers than anyone realizes. It really isn't that large of an imposition. I constantly see this. When someone has questions, I can direct them to a friend. That person will spend a lot of time lavishly. We see it in the retail community. We also see it in the institutional community. So don't be afraid to just ask the questions. Like hop on the phone with the people you know in the crypto industry. We all kind of put you in touch with each other. Like it's in everyone's best interest to get the right education out there because we want people to be informed. And once you go down the rabbit hole, that there's no going back. You're just going to continue to learn more and more. And then one day you'll be doing the educating of other institutions. The other thing I would just say is that ops are alpha in crypto. Like optimizing for your headline return is only good if you consider that the risk in crypto often comes from operational side. And so the more you can de-risk the operational side, the better a trade becomes. And so don't just focus on maximizing for headline return. Focus on actually maximizing for durability by de-risking the operational side, spending just as much time on operational as you do on the investment thesis. It will pay off in dividends. Like a lot of crypto trades have these charts that look like shark fins because you're actually underwriting more risk than you realize if you go in kind of quickly. You're making great yield, you're making great yield, oh, it drops off due to an exploit, etc. And then if you go and do things safely, it might take a little more time. You might not be generating the exact same high level yield, but you actually were never earning it to begin with. There was always an embedded cost, an opportunity cost that you were paying for doing it. If you can do really strong operationals at a firm, you can create a much more robust crypto product that outperforms the market through time. Those drawdowns are not only scary for allocators, but they're also ruinous to your return profile. We all know how compounding works. And so you really do want to create a consistent revenue stream, not try to optimize for kind of maximizing in the short term. And that comes from ops.
Awesome. That's great advice for sure. Well, unfortunately, that's all the time we have for this segment. Big thanks again to Matt Sheffield for joining us today and sharing his journey and insights from inside Sharplink Gaming. So we will take a short break for now. And when we come back, we'll be joined by Ian Weisberger, the CEO of CoinRoutes. He'll break down how institutions actually trade and buy crypto and what really matters behind the scenes when size, liquidity, execution come into play. So stay with us. We'll be right back here on RoxomTV.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
Welcome back to Roxom TV, and thanks for sticking around with us after the break. We are going behind the scenes of institutional crypto trading, like how the big boys, how big players actually buy and sell crypto, what they care most about, and where most people get it wrong. Joining us this segment is Ian Weisberger, co-founder and CEO of CoinRoutes. CoinRoutes built the execution and routing infrastructure used by institutions, funds, and professional desks trading across dozens of crypto venues. So today, Ian will share an insider's perspective on how institutions really trade crypto, from execution quality and liquidity to hidden costs that most retail traders never see. So Ian, welcome to the show.
Yeah, thanks for having me. So I actually got into crypto kind of personally in 2015, but we started our business CoinRoutes in 2017. And it's been amazing to see kind of the growth in the industry, how the industry has really evolved from, okay, this is only used for illicit things to now the biggest financial institutions in the world are trading this asset class. So it's really been it's been a cool journey to be here.
Yeah, I wonder what was the aha moment that you feel like, okay, it's a good time to enter crypto right now, and especially build a platform catered to institutions.
Yeah, so back in 2017, I was trading, just personally. I was working in Wall Street, and I was trading a bit, and I saw that there were $3,000 price differences between the different crypto exchanges, over 10% at the time. And so you were able to arbitrage and just make money trading these instruments. And also the markets were extremely inefficient. And so we sat down and we decided to go and build what became CoinRoutes.
Yeah, so one problem that CoinRoutes is solving is definitely the execution price as well. So I wonder what sort of like market structures were you fixing that TradFi tools might not be doing, but like CoinRoutes is offering a solution to them.
Yeah, I mean, look, it's interesting because crypto has always been this market that trades 24/7, 365. And it's funny because now you're seeing these TradFi institutions start to offer, like Robinhood, for instance, is offering 24/7 trading on stocks, right? And so it's funny because crypto markets and equity markets and traditional markets are actually converging in a way. So, the systems are just different, right? And so when we started the business, the existing systems didn't really have the capability to support this sort of market microstructure, right? And so our system is built from the ground up for trading crypto and also other asset classes. There's been kind of a huge evolution in the space where the same traders that are trading Bitcoin are also trading gold and stock futures and other commodities, et cetera, et cetera. So the markets are kind of converging in our opinion.
Yeah, so one nature that I noticed from CoinRoutes is that you route across different venues, so more than 60 venues. So right now, CeFi and DeFi are coming together. I wonder what changes they come together, basically to converge.
Yeah. I mean, so DeFi venues are these decentralized protocols, and when we started in 2017, they were slow and clunky, and you couldn't really get a good trading experience. Recently, in the last couple of years, they have really improved a lot. So you have exchanges like Hyperliquid that are as fast as the ones that you would know, like Binance, right? And so these decentralized venues are just as feature complete in a lot of ways as the centralized venues. And so you're seeing a lot of liquidity migrate to these venues. And so you need the ability to trade on both centralized and decentralized venues from one system with one stack. And that's what we provide to our clients. There's a lot of new market participants and market entrants today that don't even trade on centralized venue, that might just trade mostly on Hyperliquid, right? And so that's been interesting to see.
Yeah, let's talk about the recent progress because there is a DYDX partnership going on. Like,
Yeah.
what does being a DYDX governance approved partner say about like TradFi style execution moving on chain?
Yeah, I mean, they're one of our many exchange partners. We like to announce different partnerships with different exchanges. We just announced a big partnership with Avenir Group, which is a big Hong Kong firm that offers a lot of different products and services and is a big asset manager. And so it's really interesting for us to be striking partnerships, not just with the crypto native people, but also with kind of larger institutions. We have a number of flagship clients that might not be in the press release as well, that are large institutions that we're able to support, and it's only going to really accelerate as the crypto and TradFi world really converges. If you've been following the markets, you've seen the crazy volatility and price appreciation of gold and silver, and we're actually seeing a lot of the same people that are trading crypto, trading metals, and so that's something that we also support as well.
Yeah, so having all these partners from different areas around the world. So how does that? Okay, how has operating in hubs like okay, you mentioned you have a recent partner in Hong Kong. You have different colleagues in London or maybe in Dubai as well. Like, how does that help with the whole institutional adoption?
Yeah, we like to what we call follow the sun, right? Because we have people all over the world. We have clients all over the world. We have staff all over the world. And again, this is a 24/7 market. So in TradFi, when New York Stock Exchange and US equities is open from, their daytime, and then, you have Asia opening, and it's like different kind of centers, different whole teams. It's a very different kind of culture and vibe than crypto, where it's really, we have to do a full handoff. It's the same instrument trading 24/7 in all these different hubs. There's really nothing else like it. And so that's why I think companies like ours have a big advantage being crypto native, knowing that the same instrument is trading in Dubai and London and New York.
Yeah, so you talk a lot about how the market structure work as well. And one thing I think you said is like the biggest blocker right now isn't regulation in particular, but you happen to think like execution, like having bad execution is really bad for the whole market structure. Could you explain a little bit?
Yeah. I mean, so basically this market has evolved a lot in the 8 years that we've been in business, and people back in the day weren't really concerned about price because there wasn't any regulation around execution, and they were just more or less worried about getting what we call in crypto rug pulled, about losing their money. Like if you've know what happened with FTX, that was a disaster and that dragged the market back years, right? And so if you don't know that your funds are safe and that there's not going to be a bank run, it's hard for you to care about getting a better price on your position. But now I think with the emergence of these large institutions that are able to hold crypto, people are relatively comfortable in safety in these larger established players. And now they're starting to care a lot more about price, which is in a lot of ways driven by regulation, but also it's like the next thing that you look at once you have safety and custody and you have insurers. I just met with an insurer today that's insuring crypto deposits. Like, this market is really maturing, and it's starting to not exactly look the same as TradFi, because a lot of traditional financial players think it's going to be exactly the same. It's not going to be exactly the same, but it's definitely starting to rhyme.
Yeah, it sounds like there is a lot of misconception, especially like you come across with like TradFi people, with crypto founders, crypto projects as well. So, what do people still misunderstand about how institutional crypto trading really works? Like, because when I talk to my basically my community, they happen to think institutions only buy and hold. Is that really the case? Is that really what your clients are doing?
Yeah, I mean, look, so a lot of our clients are what we call market neutral funds. We have buy and hold, we have long bias, we have short bias, but there's this whole class of manager that exists in traditional assets as well, where they're basically looking to make money on the difference between the price of a futures contract and the spot. And so there's a reason for that structurally. In traditional markets, you might be, if you're a holder of of corn, you might sell corn futures in the future, right? And so that allows someone to basically buy from you in the future, but you're a producer now. So you have this market of producers and speculators, and it's this whole convoluted market where when there's actually goods that are required. Crypto's a bit different because, I mean, Bitcoin is, I guess you're using it for money, for buying stuff, but it's not like it's required like oil or corn. So it's a bit different, but structurally the markets operate very much in the same way. And so what our clients are able to do is essentially make money, make yield, make whatever between 10 and 20% yield on cash, on their dollar fiat equivalents, by trading in the crypto market. And that's a whole type of trading that is important for the market structurally, and also provides liquidity so that retail traders can buy and hold across exchanges, because there are different types of exchanges in different regions. So for instance, back in the last cycle, there was what we used to call the kimchi premium. So the price of Bitcoin on the Korean exchanges was more than elsewhere, and that was structural because it was hard to get cash in and out of the market. That doesn't really exist anymore, but there's different opportunities for savvy traders using a platform like ours to make money. And even a lot of individuals who might want to get more than the 3-ish% they're getting on their cash, they might want to go and invest it in crypto vaults and crypto products where they can get yield on their assets.
Wait, so the platforms that you're building, not just for institutions, like retail users can use it as well, right?
Yeah, I think like that is a direction that a lot of these platforms are going. I would say it's more high net worth, so people that are trading in size can use a platform like ours. But I would say that retail traders are indirectly benefiting from products like ours because we are allowing the market to become more efficient. And so the people that they are trading against are using tools like ours, and in a sense, they're getting a better price when they buy and sell crypto because of platforms like ours that are enabling the institutions that is essentially taking the other side of the trade. So when a retail user goes and buys Bitcoin, they're buying from a market maker. Many of them use our platform to be able to quote and trade and basically facilitate the marketplace.
All right, so since you deal with institutions, you deal with high net worth clients every single day. So when they're trading, like in a fast and very volatile markets, usually what would break first? Is it like pricing or liquidity or execution? Like what they most concerned about?
It's a really good question. So there was a huge event, the flash crash on October 10th, that we think probably caused a lot of firms to become insolvent. There was news that BlockFil's paused withdrawals probably I would guess, would have to do with the fallout without knowing more. But essentially what happened on that day was the price fell so quickly that the crypto exchanges had to liquidate traders, both traders that were making money on one side. And as I talked about previously, there's this whole structure called market neutral trading. What that means is a hedge fund or institutional trader will sell crypto on one exchange and buy it on another. So with respect to the exchange that they have sold crypto on, they've made a lot of money because the crypto price has dropped. But with respect to the crypto exchange that they were long on, or they went, they purchased Bitcoin on, they would have lost money. And the problem with these crazy flash crashes is the exchange that's liquidating you doesn't know about your overall position. So in other words, what happened was firms lost huge sums of money because they thought they were neutral with respect to the price of Bitcoin, that they were long and short, and it canceled each other out. But actually, one of the sides of the trade blew up, and that took down whole firms. And we at CoinRoutes were actually wondering, like, which firms blew up. Our clients didn't blow up. Our clients were mostly fine. But turns out, yeah, there's definitely firms that have blown up in the industry after the fallout of that event. And that's kind of the issue with this market is these big crashes can cause firms to be, to blow up. And I think a lot of the price action that we've seen recently has been fallout from some of these crazy volatility events.
Yeah, I mean, that is a really good example because like 1010, even till today, we are seeing the effect. That's why people are calling it a bear market. So for your own take, your own perspective, what exactly happened on 1010? Because right now we still haven't got an official answer, right?
Yeah, it's really pertinent now, I think, what happened on 1010. And for those of you who don't understand derivatives leverage trading, it's extremely complicated. But basically what happens is there's this thing called auto deleveraging. And what that means is the exchange, if you sold Bitcoin at 110 and the price went to, 90, they might say, okay, you made a lot of money on the 110 to 90 drop because you were short. So we're going to strike your price at 100. And so what that means is you lost out on the drop from 100 to 90 in profit. And that's a huge issue for you if on the other side of the trade you were long and then you lost, 10%, you lost $10,000 of price movement. So people got washed out that way. They lost huge sums of money because of this auto deleveraging mechanism. That's something that doesn't exist in the TradFi markets. I was speaking to a large traditional hedge fund about trading perpetual futures, and we were like, oh, how are you going to manage this? We can help you do it, blah blah blah. And they were like, what's auto deleveraging? And so it takes a lot of education to educate people on the differences between crypto market structure versus traditional assets. And one of the biggest differences is this idea of auto deleveraging. And I actually have argued with people on the internet about this that have said, oh, this is crazy and we need to get rid of it and it's awful and it doesn't need to exist. But there's a huge structural difference. In traditional assets, when you're trading with a broker, they will, on futures markets, they'll basically do a credit check on you and say, okay, this is what you're good for, and they don't have to liquidate you in real time. So if the price of your instrument crashes so fast that the money you put up is worthless and you'd owe money, basically they give you a call. It's called a margin call. They used to in the olden days physically call you. Now I think they probably email you, but you guys get the point. But in crypto, that doesn't exist. It's just as the price drops, they're going to in real time liquidate you. And that's a huge structural difference between crypto and traditional markets that people should understand.
Yeah, you raised a really good point because when I talk to TradFi people, there are a lot of terms that us crypto folks just made up and then they have never heard of those terms before. So you brought up a really good example, so auto deleveraging. So what else do you think is still missing in the crypto market, and hence we are experiencing this huge volatility, even compared to gold, even compared to stocks market?
Yeah, I mean, there's a lot of stuff that's kind of half missing where you have it, but it's just not as mature as TradFi markets. A lot of that, there's a lot of settlement tooling that does exist, but it's just not as entrenched. In US equities, for instance, you have the central clearing DTCC, which is central clearing for all US equities. And it's done kind of by regulation, you have to basically use them if you're an equities exchange in the US. That sort of level of regulation doesn't exist in crypto. And in a lot of ways it can't, because you have the same instrument trading in New York and London and Hong Kong. It's not like they're actually different exchanges. So ultimately what we're seeing now is the rise of many different settlement networks. Each one of them supports a number of exchanges, but not all of them. And I think structurally, because the crypto market is so global and is so fragmented, it's not going to be exactly the same. That said, a lot of the tooling that does exist in traditional assets now exists in terms of the settlement networks, the custody provider, the custodians. There's a number of publicly traded custodians now in crypto. That wasn't really the case when we started this.
Yeah, I mean, ultimately, crypto is still so young, so we're slowly maturing, we're slowly getting there. So, what is the biggest trend in institutional crypto trading over the next few years, and especially CoinRoutes for you? What's in your mind?
Yeah, I think as I said earlier, this idea that we're going to have clearing networks and prime brokerages that service this market is definitely going to exist. Right now, in a lot of ways, our clients have to onboard with multiple counterparties and put up cash and crypto to trade with different trading partners, which is a high friction. Like in traditional assets, you onboard with your prime broker and you deposit cash with them, and then they allow you to trade on different exchanges. That's definitely a trend in crypto. There's a number of providers that provide that. And so there's a lot of people that we work with and a lot of things that we can facilitate to make it less friction for people to trade, in terms of being able to provide credit and settlement and leverage. And so it's just like there's still a lot of friction, and it's slowly getting solved in the private marketplace by different providers.
Okay, one last question, and this one is coming from me personally. Like, since you're so experienced and you have been in the field for quite a while, so what is the lesson that you learned? And especially if you're looking back, if you're trying to offer some advice to someone just getting into space, trying to build something great, or maybe as a trader, like what is the one advice you can tell them? Okay, this is what I learned from all these years. This is how I survived multiple crypto cycles.
Yeah, I mean, I want to take a step back and say, like, as an entrepreneur, I think it's just so important to take feedback from clients and build what the clients actually want. I know it sounds simple, but I've seen so many firms in crypto and in technology in general that have just gone out and built what they want to build. I think early on, we were also guilty of that as well. They just kind of said, well, I want this, so this is what everyone wants. So that's just not true at all, right? And so it was really important for us early on to say, look, like we had in the olden days when we started, we had limited resources. And so it was really important to focus our energy on what is actually required, right? Like what clients are actually willing to pay for and actually want, and doing customer interviews and doing all of that is extremely important. And then the other thing I would say is like, this market has just changed so much with AI. Like it has really flipped the narrative of what a tech company is, what a fintech company is on its head, because now it's easier than ever for people to build stuff. And so for us, our moat is really, our distribution and our proprietary data that allows us to have a moat. Because if it was just software and it was just some code that could be written, then at this point in the age of AI, it's kind of easy to copy. So we're really focused on the network effects that we have and the proprietary data that we have.
Awesome. I love that. But unfortunately, that's all the time we have for today. So huge thanks to Ian again for joining us and sharing an insider's view on how institutions really trade crypto and what actually matters behind the scenes. So that also wraps up my show here on Roxom TV. We got more shows lined up here on the channel. So I'll be back same time tomorrow. So make sure to tune in. Thank you guys for watching, and see you guys tomorrow.